Well, that is the closing bell on Wall Street, and now is Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jerry Blickery at the New York Stock Exchange to get you up to speed. Right up to on today's trade. Let's see where the major averages did end up here. Where they ended up was in the red. The Dow down about 700 points. The S&P 500 down 2.2%. The NASDAQ down about 3%. What were they ducking into? Remember, last week they were selling stocks, U.S. bonds, dollar, all U.S. assets. Not today. You look at treasuries, they catch a bid. They're rallying. I'm looking at the 10-year benchmark here, 428. Now over to Jared for a closer look at today's sector action. Jared.
Thank you, Josh. 24 hours ago, we were celebrating the lack of volatility in the boring markets. Not today. We are seeing a resumption of the downtrend with the Dow down almost 700 points. The NASDAQ leading the way down 3%. Even the Russell 2000 off about 2.5%. And just looking at volatility, I've been tracking the VIX very closely. It hasn't jumped up a huge amount today, but it just seems very comfortable. And this is a year-to-date look, hanging above the 30 level. And that's something you see when institutions are still facing a lot of uncertainty. So that's a trend that we see continuing here, if not resuming. ICE B of A Move Index, the VIX of the bond market, that's still elevated as well. This is another year-to-date chart, but not too much movement from the day prior. And let's check out the 10-year T-note yield. Josh, you were just looking at that. It is down 4 basis points. Not a huge move, but it was only last week that we saw that huge jump up and volatility that we haven't seen, move up that we haven't seen since 2001. Let's check out the sector action where we see only energy finishing in the green today. We were just talking with Dan Dicker about the oil market, crude oil up today. So energy green, but its antithesis in these markets, tech down 3.5%. And a lot of times, the old times, we saw energy moving the opposite way of tech. That trend has resumed. But look what else is down, each of the mega cap sectors. So not surprisingly, if we take a look at the NASDAQ 100, a sea of red here. A couple of green spots, looks like Strategy, FANG in the green here, Dollar Tree, but Apple down 4%, Microsoft, Nvidia down almost 7%. And of course, the decline started last night on some of that news regarding Nvidia, and you see this manifested in the semiconductor screen that we're looking at right now. Taiwan Semi down 3.5%, AMD down over 7%, ASML also down more than 7%. So facing some pretty steep losses there. Also seeing this bleed over into software. We're not seeing a whole lot of green here. Microsoft down 3.5%, Oracle down 3%, CrowdStrike down 3%. And then looking at finally for tech, unprofitable tech, we see a couple of green spots here with Shopify, Roblox, DraftKings, Unity, but for the most part, seeing a more red than green. I want to leave us off on a green screen. So for that, I'm going to send us off on energy, where we see Exxon up 1%, Shell up 2%, and a little bit of hope here in an otherwise pretty red tape. Back to you guys.
Thank you, Jared. Let's bring in now Michael Antonelli. He is Managing Director and Market Strategist at Baird. The firm has $490 billion in client assets under management. Michael, it is great to see you here. You know, before Jay Powell spoke, Michael, I might have led with what we were seeing in the chips today. I mean, semis came under a ton of pressure, but Jay Powell did speak, and it didn't seem, Michael, like the stock market liked what they heard. He was talking about how, well, Trump tariffs, they could generate higher inflation and slower growth. And it seemed like, Michael, market heard that and said, well, okay, if you were thinking a rate cut was coming anytime soon, maybe not so much. But what you listened to Jay Powell, what did you make of what you heard, Michael, and the response in the markets?
Yeah, thanks for having me on. It's such a crazy moment. I think there's two things that the market is always asking itself, and that is, number one, what is the Trump put? And what is the Fed put? It's always asking those two things, like how low will it go for the president to walk back, and how low go for the Fed to essentially, I don't know, do something, quote unquote, something. In both instances, I think the put is way lower. The presidential put seems to be way, way, way lower, but the Fed put, I think today is being said that it is also way lower. And to be quite honest, I've been saying this to clients. What would a 50 basis point rate cut do right now for what we're facing? It's not like financial conditions are the issue here. We're trying to reshape global trade, something we haven't done in 100 years. So I'm not really sure what the Fed can do, but I think the market has been conditioned for the longest time to say to itself, what will you do to help us? What will you do to soothe us at this very moment? And I don't think it's liking the answer for either.
And Michael, how do you balance this for your clients, right? On one hand, you have arguably a strong economy, or we had a strong economy going into all of this. Jobs look good, wages look good, consumer sentiment was decent, earnings are actually coming out of the gate pretty strong. And, here you have all of this uncertainty, the word of the year, whether or not we're going to have a Trump put, whether or not we're going to have a Fed put. What do you tell your clients? Are these investable moments, or are these sideline moments, in your opinion?
It's tough because everything feels new. Every sell-off feels new. The reason for a sell-off or what we're facing always feels new. We like to remind them that in our wealth management experience, they are a part of a plan, and the plan is meant to handle kind of all the difficult moments that we deal with. So we like to remind them that the plan is the kind of lifeboat in times like now, and that's what we do for them. But I, as a strategist and a market kind of prognosticator, do like to say, look, there's reasons for upside and there's reasons for downside. The upside is probably all about walking back the tariffs and maybe some talk about taxes and some tax extensions for TCJA. So there is potential upside. And the fact that American companies are pretty resilient. They're really quite resilient entities. But there's also downside, right? If this gets worse, if economic data starts to decline. So ultimately, there's one way to approach that, is to remind them that planning will always be the key to uncertainty, but also that it's not all bad. We can't think about this as being all bad. There is hopefully some upside here.
And Michael, where does that upside get you by the end of the year if you had to be a betting man? Where do we end up this year in terms of that?
Right. The stats are really not in our favor. I'm sorry, but they're just not. Anytime the stock market has fallen 15% in a calendar year, anytime that has happened since 1950, it's been negative for the year all but 2 times. And those other 2 times were 2009 and 2020. So those were crisis years. But in general, when the stock market falls this much, it generally tends to end the year negative. So absent some sort of gigantic deal or walk back on this, you would think that the stock market, since it's April, probably doesn't have the juice to end up to the upside. The downside, my friends, though, we do need to talk about that really quickly. In my view, it's not more trade tariff stuff. I just don't think it is. That we've dealt with that for a while. I think the downside to the stock market, real downside, is economic data collapsing, is jobs losses, is inflation perking up. And for that, I watch the 10-year. That's what I'm watching right now. And right now, it's kind of in the middle of its 3-year range. So, but the downside is economic data, not more tariff stuff.
Michael, always great to see you, especially on a day like this, my friend. Thanks for joining us.
Yeah. Thank you, guys.
The market has seen outside swings to both the upside and downside due to tariff whiplash. The volatility index soaring last week to the highest since early 2020. That's according to Bloomberg. As investors continue to grapple with uncertainty, where does this leave the options market? Prosper Trading Academy CEO Scott Bauer joined us now to discuss in the Options Pit, sponsored by Tasty Trade. Scott, it's good to see you. So,
you too, Josh.
May start here, Scott. Listen, lots of volatility in this market. What kind of opportunities do you think, Scott, that presents to investors, especially maybe, Scott, investors who are listing right now and they're new to options?
Sure. So if you're following the VIX, and I'm standing here in the VIX pit at the SIBO, if you're following the VIX, something to remember is if you see a VIX more normalized long-term around 16, that's equivalent to about a 1% move in daily move in the S&Ps. 32, which is pretty much where we're at right now, that's a 2% daily move. 48, 3%, so on and so forth. When we see this elevated level, 30 or above, it typically does not stay here very long. In fact, if you look at historically, going back to when the VIX started back in the mid to early 90s here, above 30 is, maybe it stays for a few days, maybe we see a week, and then we normalize here. In fact, over the history of the VIX, anytime it's really soared and it's gotten above 50, which is really kind of a capitulation, panic level for most investors here, that year, the returns and moving forward have all been positive. So is this time different? You guys were just talking, maybe this time is different. When we go through these cycles, we always say that, whether it was COVID, whether it was, the Y2K issues, whether it was a great financial crisis. Is this time different? Maybe. I'm not an investment advisor. I'm a trader. So it's easy for me to just say, hang on, hold on in there. The opportunity really is, though, quite frankly, to sell some volatility.
Kind of a broader question, Scott, too, just while I have you. I mean, listen, Scott, you've been thinking about and studying and trading these markets for a long time, especially on a day like this. I think a lot of people, some people at least, investors can get nervous when they see a day like this. Just broader, Scott, I'm just interested what you make of these markets.
Well, it's difficult. It's really difficult, to be honest, because we really haven't been through a time before, regardless of the periods of time where we've seen the VIX spike, where we know the markets can change in a heartbeat, literally in a second, on a tweet, on a news clipping. We have not been through that before. So I think this time going through here, that uncertainty is heightening that VIX level, is heightening, some of the nervousness that people are feeling out there. And the fact that we keep seeing changes almost on a daily basis coming out of the administration is also a very unsettling feeling. This too shall pass, but is it going to be a matter of days, weeks, months? Is it going to continue through the end of the year? I can't tell you that. I know that the opportunities to trade, though, are excellent. The markets in the VIX, the markets in the S&P, they're deep, they're robust, they're liquid. So as a trader, it's great. If you're a longer-term investor, you probably just got to look historically and say, all right, I'm along for the ride.
And Scott, we were talking earlier about semiconductors and the different opportunities there. I know you have some ideas around TSM. Can you give us some trade color on that and what you see in the options market?
Absolutely. It's really tough just because of the constant news cycle. If it weren't for what's going on right now, I have no qualms that TSM would be a $200 plus stock. But we do have, the current news cycle to contend with. Earnings tomorrow morning, I want to be long this stock, even in the face of everything that's going on. So what I am doing is I am selling next week's expiring 150, 140 put spread, $10 wide put spread. Could have done that for about $3.5 today, which was a lot of premium. I normally would not sell a put spread that wide, but looking at this stock, I want to be long this stock, 146, 147 area, if it were to come down there. So I don't mind selling this put spread, getting the expensive premium, and then seeing what happens. Again, if I had a longer time horizon on this, if it was more of an investment than a trade, I would probably look at it a little bit differently.
Scott, great to see you and to have you on the show today. Thanks for joining us.
Thanks so much.
Well, gold not only hitting record highs this year, precious metal also taking the crown from tech stocks as the most crowded trade on Wall Street. Yahoo Finance's Inez Ferre joins us now with more. Inez.
Yeah, Josh, and this is from a B of A survey that basically said that for the first time in 2 years, the Mag 7 is not the most crowded on Wall Street, the most crowded trade, but it is gold, which today hit a new all-time high above 3,350. And just to show you the performance of gold year to date compared with the Mag 7, take a look. Gold up 26% year to date for the futures, and if we look at the Mag 7 stocks year-to-date chart, I'm going to show you the NVIDIA down 22%, Apple down 22%. So all of the Mag 7 components down at least double-digit percentages. Also in this B of A survey, you had these fund managers, 73% that said that U.S. exceptionalism has peaked already. And despite the rally that we've seen in gold, up 26% year-to-date, you have 42% of them that say that gold will be the best performing asset of 2025. That is up from more than 20% just the month previously.
Thank you, Inez.
Thank you.
Stick around. Much more market domination overtime. That's still to come. Home builder confidence remains in negative territory in April. Growing economic uncertainty from tariff concerns weighing down on builder sentiment, while rising material prices also due to tariffs have home builders seeing costs rising per home by thousands of dollars. National Association of Home Builders CEO Jim Tobin joins us now to discuss. Jim, great to see you as always. Jim, so Fed head Jay Powell today was speaking. He was talking about the Trump tariffs, Jim. He's talking about how, listen, that could very well mean higher inflation. It could mean slower growth. I'm curious, Jim, when you think about these tariffs, how you're thinking about them for the home builders, Jim. What are the implications, the ripple effects you're looking for?
Good afternoon. Thanks for having me. I think the ripple effects are yet to be seen, but we're anticipating higher prices. We saw our HMI, which is the NHB Wells Fargo Housing Market Index, go up only 1 point this month to a reading of 40. That's still well below the break-even point of 40. And when we survey the builders on this, they're already seeing price increases up to 6% from their suppliers, which translates into over $10,000, almost $11,000 in increased costs when it comes to building a new home. So we also view the tariffs as inflationary, and I don't think if we know the full impact yet.
And Jim, what do you think is the way out of this for builders, right? There was a sentiment survey out there. 29% of builders said that they're going to have to cut home prices because of the, tariffs and spending and things like this. But how do builders get out of this? What is their future for the next 9 months with tariffs coming in?
Well, I think it's going to have to be a lower mortgage rate environment. I think the reading, our HMI went up 1 point this month, and we think that's largely due to that dip in mortgage rates we had a couple of weeks ago. So if we can see a quick clear of the bond market starting to settle down and hopefully bring mortgage rates back down into, closer to 6.5, I think some people will begin to come off the sidelines. That said, it really is market to market. I was just in Florida this week visiting our builders down in the Panhandle, and they're doing very well. Money is flowing. People are coming down there to buy homes, and home construction is booming. But yet, when I talk to our builders in Milwaukee, Wisconsin, border state, a lot of trade comes across those borders from Canada. They've seen the market kind of swing both ways. People pulling out of the market, not wanting to buy a home or start a home, but then yet coming back in over the last couple of weeks saying, well, maybe now is the time. So it's uncertainty is the word of the month, and probably the word of the next couple of months when it comes to home building in this country.
Jim, I assume you're talking to the Trump administration, so I'm just wondering, when you talk to them, what are you telling them, Jim, and what's their response?
We are talking to the Trump administration. They're very attuned to what's going on in the housing market. They have made a pledge on the president's inaugural day to lower housing costs and build more housing. So for us, it's all about just explaining the impacts that these tariffs are going to have. Our three largest trading partners in building materials are China, Canada, and Mexico. So these tariffs on Mexico are gonna bite pretty hard in the short term. But again, we're hoping for better trade deals, which means we'll ease those tariffs. We can get to fairer trade, and we can get back to some balance in the markets right now. And again, I think there's a long way to run on what the Trump economy truly looks like. Between the deregulatory actions this president is taking, we've already seen several of those aimed at the housing industry to lower the cost of the regulatory burden on home construction and apartment construction. I absolutely have faith that the president will cut new trade deals. And of course, we have this big tax bill that the Congress is just starting to work on, and there's a lot of incentives in there for home ownership, affordable rental, and of course, the business side of the equation as well. So I still think we're a few months, if not longer than that, away from truly knowing what this economy looks like.
And Jim, given what you just said about the potential for tariffs kind of equalizing out and balancing out, what do you think the opportunity is for investors to look at some of the home builder stocks like the Home Depots and the Lowe's of the world, for example?
They're going to be there in the long run. I mean, everybody should be long on housing in this country. The demographics underpin it. We know that the millennials are coming into their prime home buying ages. So there's a lot of demand. I think it's just once the economy settles down, people feel a little bit more certainty, and then interest rates begin to trend downward again, mortgage rates begin to trend downwards again. I think that there's a lot of upside to the housing market. And I think that it's time to take a look at the home builders, and of course the building material companies out there, and be ready, because when we pop, it's going to go quickly.
Jim, I know you touched on this. I just want to double click on it quickly here. The 30-year fix, Jim, I'm just looking, Mortgage News Daily says we're at 6.86%, Jim. You got very smart economists there on staff. I'm curious, what do they tell you? What's their forecast about where they think that heads from here?
Well, again, I think we haven't fully seen the impacts yet, but I think 7% mortgage rates remain kind of the top of the cycle in the short term here. Again, it's all based off that 10-year Treasury. And as long as that stays somewhere, kind of trickling around 4.5 or south of that, I think we'll be okay. We won't get into that crooked number of 7. I like when we get closer to 5. But I do think we're gonna settle in here 6.5, maybe a little bit higher for the next several months. And again, if you have to move, there's no right or wrong time to move if your economic or personal situation dictates it. But I do think that higher handle on mortgage rates is going to keep people off the sidelines, at least into the bulk of the spring building and buying season. And that, of course, is the challenge if we want to jumpstart the housing market.
Jim, as a homeowner myself, locked in at 6.5. I agree with you. 5 does sound a lot better, Jim. Thank you, as always, for joining us. Appreciate it.
Thank you.
Time now for what to watch Thursday, April 17th, sponsored by Tasty Trade. We're going to start off on the earnings front here. Some big names reporting tomorrow, including Taiwan Semiconductor, American Express, and Netflix. Now, Netflix announcing first quarter results. That's coming after the markets close. Remember, Netflix says it will no longer be disclosing its quarterly subscriber numbers starting this quarter. But analysts still expecting that momentum to endure and drive revenue growth in Q1. And moving over to housing, we're going to be getting some fresh housing data with housing starts and building permits in the morning. Economists expecting both starts and permits to decrease in March to 1.42 million and 1.45 million, respectively, on a month-over-month basis. And taking a look at the Fed, got some more Fed commentary coming in tomorrow. That's going to be from Fed Governor Michael Barr. This is coming after comments earlier today from Fed Chair Jerome Powell. Powell speaking today at the Economic Club of Chicago, and the markets experience, we know, a sharp sell-off as a result. Powell saying that the effects of tariffs are moving the Fed away from its dual mandate goal of price stability and maximum employment. That's going to do it for today's Market Domination Overtime. A big thank you to Sylvia Jablonski for hanging with me today. Sylvia, it is always great to see you, but I have to tell you today, it was especially helpful. Appreciate it.
Thank you so much for having me.
Covered a lot of ground, too, by the way.
Did.
Everything. All right, don't go anywhere. On the other side of the break, it's Ask for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.